Hello everyone, my name is Clarence with Geneva Financial, and thank you for attending this video today, or watching this video I should say. I want to talk about some solutions with people with debt, student loan debt that is, and this is a big deal because so many people have student loan debt, and I want you guys to know how we can create solutions to assist our clients and your clients and help them get out of the renter cycle. All right, before I get into that, I want you to take a moment, smash that like button, smash that like button, smash that like button, and then hit the subscribe button so you're notified every time I drop a video like this. All right, let's get into it. All right, did you know 43% of college-educated Americans have stated they are postponing buying a house or refinancing due to their student loan debt? Considering that there are 87 million millennials and many of them with student debt, the potential in this market is staggering. Our goal is to help them find a solution and figure this out so they can achieve their dream of home ownership, or maybe just getting out of some debt they have. Just because someone has student debt or a college degree, it does not mean that they fully understand debt enough to know how to repay it, or even restructure it to their advantage. Here's where I can help out with that. The first step in looking for a solution to your issue is to understand the type of repayments available. I'm going to review some of this in great detail. First of all, fully amortized debt loans, income-based repayment loans, loans that are deferred or in forbearance, loans that are subject to forgiveness or grant, a very popular employment-based repayment plan, and what happens if mom or dad or someone else is paying the loan for you. A fully amortized student loan is a loan that is being repaid on the original terms. No changes have been made, and the full payment is being made for the term to be agreed to. An income-based student loan is an income-based repayment plan. Upon graduation, many people are unable to find jobs that can pay their monthly student loans and provide food and housing. As a result, student loan services companies set up payment plans that were more aligned with the person's income. Under the income-based repayment plan, the payment is determined based on your monthly expenses and is seen as an affordable way to pay back your student loans and make life a little easier. The downside of this program is that it lengthens the time of repayment and therefore the amount of interest that you're going to be paying over time. So keep that in mind. Now there's an upside. Most clients who don't know about this program may be able to exercise this option to reduce their student loan payments in order to qualify for a home purchase or a refinance. So make sure you look into that one if you need to do that. It's a good one. All right, when student loans are in deferment, this allows the person to postpone the payment on the student loan. You may have seen those returning to college or graduate school, or perhaps those who are going into an internship, some kind of clerkship, a fellowship, or residency program like a doctor per se, or maybe an attorney. Okay, how much payment will be needed to be considered to buy a home when the loan is in deferment varies depending on the loan programs. For some programs, we don't need to count the payment if it is deferred for 12 months or more. For others, the lender will calculate a payment based on credit report or a percentage of the balance. We do that all the time. This is why it's important to send your client to me first so we can figure out what their payment is exactly going to be so there are no surprises when you get the loan. Okay? And also it's good to know what you'll be qualified for based on your situation. All right, now when your loan is in forbearance, the borrower is allowed to temporarily stop making payments on their student loans. Reasons for forbearance include medical issues, changes in employment, or financial difficulties. Investors may, on the guidance for loans and forbearance, so this is something I always, need to explore with our mutual clients. Very important there. All right, so one of the hottest trends in employment or competitive fields is employer-based repayment programs. Some industries are heavily competitive for talent, and one way to beat out the competition for that talent is to pay a person's student loans. Did you know that? That's really cool. We are seeing this in medical fields, technology, and even trades where demand is high, but talent is tough to find. Employer-based repayment plans may be, or even full payments. So it's, very careful. Let's just talk about, see what works. How they are structured, such as contingencies and program details, will directly impact how we qualify you as a client. If you have a client in one of these types of programs, contact me immediately so that I can discuss the details and how they may or may not affect qualifying for the loan. All right. Many potential home buyers have been given a false narrative when it comes to qualifying for a mortgage when someone else pays the student loan. They have been told that if they're on the loan, the lender has to count it. And that's just not true. If we can document that someone else has been making the last 12 months payment, we don't need to count it. So we're going to need canceled checks. We're going to need to see deposits or stuff coming out of your bank account. It's really simple. That way we can say we don't have to count that. We can offset that. This is when a debt is repaid by a family member or someone else. When the agency that buys the mortgage notices that many people are being helped by family members, they made some changes to their guidelines, which has helped a lot of borrowers. This is just also another option that may be available to some clients. This is the option of having someone else pay for their loan or assuming the debt. So a lot of things out there that you need to be aware of. Student loans have become such an issue that Fannie Mae came out with a special program. It's called a Fannie Mae Student Loan Cash Out Option. This is a special cash out program that allows a person to use the equity in their home to pay off their student loans. A great refinance. Yes, there are a number of homeowners with student debt but have equity. And this is an option that few people know about. The end result is it typically lowers your overall debt obligations, so that this program should be explored. It's a great one if you got a lot of debt and you've got some equity. It also allows you to pay off the debt, so when you go to sell that present home, you don't have to worry about qualifying with the student loan debt because your home is going to sell and that's gone. So that's a really good one to take a look at too. Now, the LTV limit or loan to value on this program is 80%. And it does require that all student loans are paid in full, not just some. Fannie Mae has also offered more incentive by waiving pricing adjustments that they usually charge for this type of program, which can substantially reduce your interest rate. Definitely hit me up if you're in this situation. Now, sometimes my clients will talk to me about consolidating their student loans. If you're familiar with student loans, they often aren't just one loan. Typically, there are many loans, and you have to make payments on each one. This is why some people consider consolidating them into one payment. I may do a video on that another time because there are pros and cons of consolidating in another video. I'm not going to jump into that today. So, folks, in the mortgage lending industry, we're tasked with finding the minimum payment required to be used to qualify people for mortgages. When it comes to student loans, I can tell you that this calculation varies all the time, and it could be over here, it could be over here. Some programs will allow what is on the credit report, others will require the greater of the full payment versus what's on the credit report. And still others will allow you to document the actual payment through loan documentation or a percent of that balance that is owed on that student loan debt. And as I mentioned earlier, deferred loans may be excluded from debt to income on some programs, but not allowed on others. Again, we have to have a conversation about your individual situation. We can find the best loan for you. Part of structuring your client's loan program is looking at all these variables and finding out what the best scenario is. That's why you want to give someone like me a call before you jump into the loan business. This is what I do for my clients, my realtors. I want to see what the best situation is. All right, folks, thank you for taking the time to listen to this lengthy video about student loans and how they may affect you or may not. If you have any questions, reach out to me, put a comment below, and I will get back to you as soon as I can with an answer. And as always, it's wisdom.